Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's program is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Neal Bawa. Neal is the founder of Grow Capitus, an online multifamily investor education platform. He's also an experienced syndicator, developer, and his attention to the data has earned him the moniker, the Mad Scientist of Multifamily. And in just a minute, we're going to speak with Neal about the Feds Gambit with rising interest rates and their impact on commercial real estate. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guests back to CRE PN Radio. Neal Bawa, welcome back.
It's great to be back, Darren. Interesting times, so interesting conversations.
No, that's always a guarantee with you, but definitely the times are changing. Before we jump into the conversation, if you could take just a minute and share with our listeners a little bit about your background.
Sure. I'm a data science, a technologist, successful tech career, successful tech exit. Um, I work with about 900, well, a little over 900 fairly nerdy, data-driven investors, a lot of them from Silicon Valley, and I buy and build properties across the US in 10 states and 16 metros. Portfolio is about $1 billion, and we are agnostic to any particular asset class, but the largest portion of the portfolio currently is multifamily, both new construction and value add.
Got it. And you said agnostic. Have you, how far have you strayed from the multifamily asset class?
In my mind, very far, and sometimes people don't quite get this. So, I've done townhomes for sale. I've done fourplexes for sale. I've done fourplexes for rent. I've done build to rent communities, which are very different from a standard multifamily community. I've done other asset classes like industrial, self-storage, student housing, and I'm still missing one or two.
All right. All right. Well, I think it's good to kind of test the other stuff there and get a feel for how they play and get to know those different asset classes. That's great.
Yes.
So
I certainly don't suffer from the grass is green on the other side problem.
yeah, you're mowing on both sides. I get it. I get it. So Neal, it's been a little while since we last spoke. You've been very kind with your time and coming on the program here multiple times. And I think the last time we talked was probably about a year ago, when we were kind of working through COVID. Things were still good. There was kind of the sense that the Fed was working to slow inflation, and the expectation was the interest rates were going to be pushed upward, and that the fear was there was going to be a crash. And here we are today, where we are recording this in February of 2023. We're clearly feeling the effects of, or the interest rates have been pushed up. Inflation has not necessarily been, is not under control just yet. The fear of a looming recession is still evident. I mean, there's plenty of evidence of that. I mean, And so I guess my first question to you is, uh, as the landscape sits before us right now, what is your just immediate sense of things, just with respects to the multifamily marketplace?
Um, what I would say is that the market is not doing a very good job of adjusting to its new reality. So I feel like there is this sense of we've had it good for so long, right? The last 8 years have been so good. And every time something bad happens, something changes it. Like, for example, COVID was actually a very positive change for the multifamily industry. Just when we felt like all the cash flow is getting squeezed out, COVID comes along, and then the Fed, showers all this money and interest rates go to zero, and it's party time again. Actually, the biggest party of all time in multifamily was in 2021. And so something always comes along and bails us out. But I feel like there's no evidence at this point that there is something that is going to bail out the industry, but I still see too much of a party-like atmosphere. I don't see acknowledgement either of the fact that today you can't really buy a value add property with significant cash flow. I mean, 1%, 2%, sure, technically that's cash flow, but I think that if your property is producing 4 or 5% cash flow, you're probably being a little aggressive with your underwriting because I don't think that that actually exists. Um, and so when you're in a situation where you're buying, you're a cash flow industry, you're a cash flow asset class, and you're cash flowing at 1 or 2% or 3%, and 40% of all buildings purchased in the last 4 years are either just breaking even or bleeding, then the sort of attitudes that I see in podcasts and conferences needs to be adjusted. So my answer to Darren is the industry is in a process of adjustment and not doing a very good job so far.
Yeah. No, I've in my own mind, I've kind of thought that it's that transition phase between where we were and the expectations that things are going to go back, or the kind of the reality, of where we really are, and that change in reality.
Mhm.
And I think the only thing that you know, cures that is time. It takes time for people to realize, the marketplace to realize that what was is not anymore. This is the new reality. And
Well, I think what helps is having open discussions because there's people that are going to listen to this podcast that I think will have a slightly changed point of view. If there were 90 people or 200 people on 200 podcasts having this conversation, then that pivot to reality would just go faster. It takes time, yes, but it takes less time. And I think that that's why having these kinds of conversations is even more critical than the sort of conversations that we've been having on this podcast for the last 2 or 3 or 4 years.
yeah, no, and I wonder too, does the conversation and the reality accelerate as the financing that one has in place expires and has to reset? And does that not necessarily, either force a sale or force a refinance, or, kind of that recalibration happens when we've just come out of some very low interest rate terms. Those who were looking to refinance probably locked in at a pretty good rate. They've got some runway to work with. But those that are coming up on an expiring term, or are looking to sell or have to refinance, they're facing a different reality. And I'm wondering if your thoughts on as they go through that transfer, if that doesn't kind of cement for more people that what the new reality is.
It's beginning to cement it. The problem is there's no education around what to do, right? So I am yet to see a course, and most syndicators today did not go through a college education course. They didn't go to Utah University's real estate program. They basically went to a weekend course or a 5-day course and then signed up for some kind of mentorship and they became syndicators. That's the standard path, right? So you look at that and you look at the curriculums of all the gurus, and it's good. I mean, the stuff that's being taught there, underwriting, stuff like that, what to look for in a property, excellent stuff. But there's never any chapter on what happens when debt takes your property underwater. Because that scenario really didn't exist for the last 8 years. So nobody ever wrote a chapter, nobody ever recorded a podcast, nobody ever had a conference session on it. And so the problem isn't that people don't understand the issue. The problem is that there are very simple, straightforward, somewhat painful fixes that people are not aware of because no one has ever provided any kind of education. And now this isn't necessarily true of people speaking at the NMHC conference because those folks have gone through 2008 and they understand what are the things that they need to do. But the syndication industry, the vast majority of us weren't doing this, including myself, in 2008, 2009, 2010, right? Luckily, in my case, I had a property where I got education, forced education. But I look at what people are doing today and I tell them, look, the problem isn't just what Darren described. So what you described is there's a bunch of properties that basically have to be refinanced, and they refinance, all of a sudden those properties will go from either breaking even or making some money to just losing money, $50,000, $100,000 a month. Yes, that's the case. But let's talk about what is already happening. And that's what I really want to focus on. So if you bought, let's say you're a regular syndicator, you have a regular portfolio, you, like most of us, believe that bridge loans or floating loans are better than, being locked into a loan for 10 years, right? 9 out of 10 syndicators were using some kind of floating debt because they wanted access to, extra money from the bank for rehabbing their property. So you're like us. Well, then in the last 3 years, 2020, 2021, and 2022, and maybe a little bit in 2023, these 3 years, let's say you bought 10 properties. So your average syndicator buys 10 properties, right? I think what's not obvious in the industry is that 3 or possibly 4 of those properties are already underwater because they already had these floating loans, and these floating loans went up, they hit their cap. Some of them didn't have a rate cap, so they're still going up. And the ones that have hit the rate cap's usually been set to like 8% or something like that. And so they're at the rate cap, they're still the rate cap company is helping them with their mortgage payment, but still their portion of mortgage payment means that they're still illiquid. Now, then there's the bigger problem. Banks are realizing that your rate cap may be expiring sometime next year. Let's say it's or this year. Maybe it's August this year, or October this year. So guess what more and more banks are doing at this point, Darren? They're calling you and saying, hey, we're seeing that rate cap's going to cost you about $700,000 when you get it, and we require you to get that rate cap in October unless you're selling your property. And even if you're selling your property, even if you have plans to sell your property, look, we can't do anything about this. We want you to start escrowing $50,000 to $70,000 a month for you to buy that rate cap when it comes up in October or August. And so now all of a sudden you are bleeding already. And now you're bleeding because you have to put another $50,000 in. And we're not at the peak yet because at this point, it's pretty much guaranteed that the Fed will raise interest rates once in March, once in May, and once in June. So there's still another 0.75 increase. So if you have a $20 million loan, 0.75% is basically $150,000 more a year in interest, which is $12,000 more a month. So guess what's going to happen? In July, you're going to be bleeding $12,000 more than you're bleeding today. But today, if you're putting that bleed in from your pocket, imagine how you're going to feel putting in an additional $12,000 a month in July. And you might say, yeah, but it'll get better. Here's the problem. Nobody has spreadsheets on this. I'm looking to create the industry's first spreadsheet on actually showing syndicators what their cash flow will look like in the next 24 months based on their own projections, based on their own assumptions. And I'm telling you, that property, if it's bleeding $100,000 today and it's going to be $12,000 in July, it's still going to be bleeding $100,000 9 months later. Does that mean it needs $1 million of cash? And that understanding of what to do when you have this kind of situation is just completely missing. That's the problem. You asked this question on your, sorry, I'll get back to you, but you asked this question about risk, right? The number one risk today is not interest rates and it's not inflation. The number one risk today is complacency.
Yeah. No, I think that is you're spot on and I think it's that necessity that changes the mindset and the action. or it creates the action. And until you have that, if people keep thinking they're going to hang on, or they're going to be able to, or things are going to change, are they telling their investors that we're expecting this to change here in the third quarter? Or I mean, how are they positioning that? Because eventually there's going to be a change. Either they lose the property, the interest rates do go down, and they're able to refinance out of it, or what else can they do?
It would be very useful if you're saying those things to investors that interest rates may go down for you to actually project it. So one of the things that we do, and we give this out to anybody that wants it, by the way, we create something called the Grow Capitus interest rate tracker, and it tracks all of the usual stuff. So, where's SOFR, where's spreads, where's the overall number, which is SOFR plus the spread, where do we think the inflation is going to be in the next 12 months, where do think the Fed's going to be? And the truth is, whether you're Goldman Sachs or Merrill Lynch, or you're one of the big guys, if you read their stuff, everybody thinks the Fed might cut by 25 basis points or 50 basis points sometime in November or in December. And if you're lucky, it might be 25 basis points in November and 25 basis points in December. How much is that going to help you? That property that's bleeding $100,000, that's going to be bleeding $112,000 in June or July. Well, it's still going to be bleeding by $88,000 if that half point reduction did happen. So in January, how is your situation going to be a lot better than it is in July, right? And then July, August, September, October will all look the same. They will all look more painful. And so my big question is, how can you stay with a straight face to your investors that things are going to get better with existing properties when the most basic math, and you're a syndicator, you do very complex math and do it quite well. So clearly you don't have any shortage of math people. How do you say this? How do you say it with a straight face? I think it's absurd. And I think that everyone has these properties. I'm one that's very straightforward, saying, I have these properties. There's nothing that I did that in any way changed my problem, the problem that I'm describing. What I'm saying, though, is I'm extremely proactive on buffering up cash flow for my properties. Extremely proactive, raising more equity, getting more loans, doing everything that's needed, because and I have a monthly meeting with my team. We don't talk about anything else. We don't talk about the property. We don't talk about asset management. We just talk about this property's stability. And every month we open a spreadsheet, we play with it, we tweak it based on what our beliefs are at that point, right, of where interest rates are going to be over the next 18 months and how this property's liquidity is going to get affected. If you're not doing that religiously, and early on, by the way, we were doing it weekly. Eventually you get to the point where monthly is fine. If you're not doing this, it's your job right now, for God's sake, to be doing this with an existing property. And here you are, underwriting 30 new properties every week, making 3 offers a week, and buying a property every 3 months. And that property has the same exact problem.
So let me ask you this, because you're the data scientist here. The data that you've been kind of referring to, and a lot of the syndicators that are relatively new to this asset class. I mean, the 2008 crash created an opportunity for a lot of people to get in and get some properties that were in distress. And so if you are looking at your current properties and trying to bolster them so that you can make it through this situation here, are you looking to other historical points where the interest rates and the investment environment was similar, or are you basically just taking your what you have now and seeing what you can do to bolster your position so that you can make it through?
It's a good question. I think it's a very good question. As I think about it, the answer is we don't need to go back and look at history. 2008 was extremely unusual. It was a worldwide equity crash, a worldwide liquidity crash. We have no liquidity problems in the US economy today of any kind that I can think about. There's massive amounts of debt and massive amounts of equity available. Everybody wants to lend, everybody wants to invest. The problem is that the interest rates are so high that you basically effectively can't make a property cash flow if you invest, if you put debt into it, if you put equity into it. So our situation is vastly superior to 2009. The problem is complacency, and the problem is because, like, I asked this question. Not going to mention names, but a recent conference, somebody who holds a conference, I said, where's your sessions on teaching people about all this stuff, cash calls, recapitalizations, bargaining with lenders? What are the things you say to your investors? You need to be teaching people how to do this, because this is what they need to know. And they said, yeah, but there's no distress right now. And my question is, you realize your conference is only held once in a year. 12 months from now will be too late to teach people, because the distress basically effectively starts this quarter. And you might say, why this quarter? Well, the answer is, when did interest rates go up, right? So, in March, it was a quarter point increase. Nobody cares. In May, it was a half point. Nobody cares. And then after that, we have 475 basis point bombs, right, going to October, and then a 50 basis point bomb in December. So 3.5 basis point increases happened in the second half of last year. Well, how could there be distress in the second half of last year? Interest rates were still going up. Now they've gotten up to the point where in January you're like, oh my God, I'm losing a lot of money. But you have reserves, you can put some money in, you can raise some equity, so no distress. Q2, same thing will happen. We'll put more money in. There won't be any distress. You'll push something back. You'll take money from your rehab reserves. Q3, now you're getting seriously worried, because you're like, man, this thing keeps getting worse. By Q4, the whole industry is like, oh my God, bad stuff is happening. And Q1, I think next year, is the peak of when properties are going back to the bank. So if you're having a conference in February next year, who are you going to help?
Yeah, right. The new buyers of the properties that got lost.
Right. So, I mean, I think that's what it is. I think the distress takes such a long time because there are so many steps in the process. But why are there no podcasts about cash calls, recapitalization, bank management? What are the sort of things that you can do with banks? And I'm not saying I'm an expert at this. I'm saying I need that education just as much as the next guy. I'm just aware of the problem and the fact that it's the next 12 months, not the previous 12 months. All this stuff that syndicators have been saying about the pain in the last 12 months, there isn't any pain. All of the pain, 100% of it, starts now and goes for the next 18 months.
Right, right. And again, I think you're spot on with the in the sense that I think that at least my experience has been that people keep looking backwards with the expectation they're going to be able to recognize what's coming. And to your point is, none of the syndicators that are of note right now have been through that. So how are they going to be of any value for the coming year on how to weather the storm and how to not lose a property?
Right, and people have been saying I said this in a podcast last month, and people are like, "Why are you saying it, Neal? You should just be hiding it and waiting for these people to make mistakes and pick up their properties." No, you don't realize I won't be able to buy their properties in Q1 next year if there's contagion in the industry, because banks will stop lending. Right now, no, every bank wants to lend, right? They don't want to lend a 70% LTV. They want to lend a 55% because, the DSCRs, the numbers that they care about, are not working, right? But otherwise, every bank wants to lend on every project. Well, what if there's hundreds and hundreds of properties returning to the bank in Q1 next year? Which bank will be ready to lend to me? How is that going to be helpful to me? As an industry, we either figure out how to get over this bump in the road, because that's really what it is, by understanding, recognizing it, and saying, stop, for God's sake, buying properties at this point. Just focus on the existing ones so they don't go back to the bank. That's all we have to do. This is our job is maybe 1/10 as hard as 2009. But why aren't we doing it? Why aren't we having those conversations? Why aren't we having people actively say, hey, we've got to be talking about this stuff? And let's get some education. Let's figure out how to be better. Let's start calling every freaking lender in the industry and saying, give us 6 months of deferment. You did that as soon as COVID happened. Why aren't you making those phone calls now?
Yeah, I'm curious, do you think any of this part, or maybe part of the reason why there's not this conversation and education occurring, is that most of the syndicators, I mean, the business plan is to buy the property, renovate, and sell, or I guess rent at a higher rent, get the NOI up and then exit. But how many of the syndicator's business plan really has a hold plan with an operation to weather a storm?
I don't think that these plans were ever built because they were unnecessary in the last 6 or 7 years. Here's my plan on my existing properties. Make sure my investors don't lose money. If
Right.
I promised you 17 IRR, I'm sorry, that's not my plan. If I promised you 8% cash flow, I'm sorry, that's not my plan. Something happened that no one in the industry, not Goldman Sachs, not the Fed itself, predicted. A massive bomb went off. My focus right now is I want to make sure that I don't lose your money. That is my only business plan. And if I don't lose your money for the next 18 months, then I'll go try and recover whatever portions of the business plan I could on a property by property basis. But I'll think about it 18 months from now.
Yeah. No, I think that honesty and having that frank conversation with investors, it may not be what they want to hear right now, but as we get through this and they get to the end of it, and if you're successful and able to do that, you will attract a whole bunch more investors, from the standpoint of the honest, uh, reality-based conversation that was occurring with your investors, and I think that'll bode well.
Well, I hope so because I think that that's what is needed today. I obviously have to give up buying buildings today. I can buy buildings, so everyone sends emails out saying buildings are $20,000 a door cheaper right now, $40,000 a door. I've got a huge deal compared to 12 months ago when this building was $40,000 a door more. Well, you're probably neglecting to mention that you were, underwriting at, 4% interest rates a year ago, and now you're underwriting at 7 or 8 or 9 or even 10, right? So that part of it is rarely mentioned. And so, I mean, I look at how I can get pencils up because I desperately want to be pencils up. I haven't been pencils up for a while. And every time I pick up my pencil, I look at data and I put the damn pencil down again.
Yeah. Now, and let me ask you, so the Fed, sets the interest rates, or they kind of the overnight rate, for banks and that. And as long as I can remember, I think it was Alan Greenspan back when, he was kind of the first, uh, Fed chairman of note that really pushed the lower rates. And so it's been 20 plus years that we've had, lower interest rates. Uh, but as we settle into kind of like, and I say settle into, I don't know if it's going to settle, but I've heard conversations both on both sides, or trying to express it both ways. Um, do you think that if the market plays out like you've suggested here, and that, first quarter of 24, properties going back, uh, naturally you would assume that the Fed will then have to do something to kind of, goose the market? Do you think that the interest rates would go down because of that, or do you
No.
think that they'll try and hang on to as much rate as they can?
No, I don't think the Fed will do anything at all to help when this occurs because I want to just explain the size of what will happen. Thousands of properties could go back to the bank in Q4 this year and Q1 next year, Q2 next year, right? Please understand the size of the multifamily industry. The syndication industry itself is a very small portion of the multifamily industry. People have been buying multifamily for generations. There are lots of people that don't even sell them, they hold on to them for decades. Then there's the institutional guys that are buying multifamily with hard loans and 10-year fixed loans, and they're just laughing at the rest of us saying, hey, my property, I've owned it for 10 years, it's got another 10-year fixed loan. So, as a portion of the multifamily industry, the syndication industry is fairly small. And as a portion of the syndication industry, the properties that are actually going to be distressed enough to go back to the bank, that's still very small. And then multifamily itself is a small component of the overall real estate industry. The single family industry is larger. And then the real estate industry is only a small component of the economy. In 2008, it wasn't a real estate crash. All liquidity dried up in every single part of the economy. So compared to what happened in 2008, what could happen and may not happen, right? I could be wrong, and there may not be that distress next year. But let's say that there is distress. We're looking at dollar numbers that are maybe 1% of what the Fed had to deal with in 2008. Why would they change track? I mean, bad stuff happens in the economy all the time. The Fed didn't change track when Twitter laid off, 7,000 people, or when Facebook laid off 11,000 people. The Fed actually pointed out to people that unemployment in the tech sector has risen in the last 4 months, even though big companies are laying off people. The small ones are hiring them because they didn't have access to those people before. So point is, the Fed doesn't really react to things the way that the market would like them to react. They look at the economy as an overall picture. And within that, if there's a sector that's distressed, they're not going to jump in to help that sector easily.
Yeah. No, it's interesting as you kind of lay that out, just thinking back about the '08 and how big that was. I mean, it wasn't just, commercial real estate, but, all of
Everything.
yeah,
The
yeah,
entire
yeah,
economy was in severe distress because of a complete lack of trust, complete lack of liquidity. We don't see anything like that today. I don't see a scenario in which there's a Fed chairman that's going to vote to start dropping interest rates to help 1,000 multifamily properties in a country that has millions of them.
right, right. Do you think this could potentially, reduce the numbers of syndicators just based on, the sexy investment of real estate not performing as well, based
There's
on
a
the,
100% chance that
yeah,
there's going to be less syndicators 18 months from now than there are today. There's a 100% chance. The problem is these people don't know how to speak to their investors. So there's still people doing sessions where they don't talk about this stuff. And I'm guilty of that too myself, right? But I'm planning over the next 3 months. I feel like I've done enough to make sure that my properties are not going back to the bank. But I feel like I need to do more sessions with my investors and just have these straight talks, like straight conversations with them about what's happening in the marketplace and how it's affecting them. I think this stuff is important. And I really don't feel I lose investors that way. They may not give me money for a property 3 months or 6 months from now, but I think that there's appreciation that I'm right now pencils down. I'm not looking to buy properties. I'm not looking to, I have staff on payroll that I'm paying from my own pocket because I'm not buying new properties. I'm just focused on their money because they gave me that money. So I think that if unless that happens in the syndication industry, I predict that there's going to be a lot less syndicators. I mean, you already see brokers in the US, single family brokers have dropped by about 30% in just the last 6 months. The bottom dwellers just couldn't take the fact that homes were not selling and they went and did something else, right? The job market's good. They got other jobs. I think we lose, I'm speculating, maybe 20 to 40% of the entire syndication industry in the next 18 months.
yeah.
Now, and
I
again, that this isn't blood on the streets, right? There's at no point have anything that I said represents blood on the street. It just represents distress for individual properties.
Right, right. No, just yeah, a deal by deal challenge as opposed to a systemic, uh,
I don't
bottom
see a
falling out.
systemic problem. I
Yeah,
do see that if thousands of properties do go back to the bank, 2024, 2023, maybe, or next year, 2024, maybe a difficult year, especially early on in the year, to get lending. Where the banks are, if they're worried about properties on their books coming back into them, it's harder for them to lend at that point of time because they have to deal with those properties. So they slow down.
right. No, I'm just sitting there thinking as you're talking about the the lending environment and just kind of this education that you're working at with your investors. Um, it would seem that part of that education would be kind of just more about the cycle, the market cycle itself and where the opportunities, you know, potentially will come from or when they will come. And, if you are able to weather the storm and investors are wanting to get back in or have additional capital they want to put to use, that would be kind of the point for them to jump in or for you to go forward. But I'm kind of curious too on just the psychology with the investors. if they're, the aversion to loss, the fear of losing is so strong. And if they're in the mindset of, or if, let's put it this way, your investors the hope is that you're, like you said, you're able to not lose their investment. So let's say you're successful in that, and you have a good conversation with them, and they feel educated and they feel taken care of by Neal. And as the cycle presents itself, there's all these other additional properties that are turned back to the bank. Do you think I mean, I would assume you'll be in a better position to raise capital from those people and or anybody else? I mean, I guess the flip side is the people that lose money in the deals from the syndicators that aren't having this conversation, that are turning the deals, they're not going to have the capital, nor are they going to want to get back in the market, I would assume. Is that,
Yeah,
that
it's
makes
it's
sense?
not necessarily a good story, right? So
Yeah,
18 months from now, my job actually will be harder to raise money than it is today
yeah,
because those investors in my properties or other properties haven't seen this play out publicly at this point of time. As I said, when I go to conferences, tell people, where's the session on training on this? And they say, well, there's not enough distress yet for us to be doing this stuff. So this stuff is in our future. And because it's in our future, I think that 18 months from now, there'll be investors who A, have been burned, with the property going back to the bank or, having to put in cash, or B, they've been with somebody like me and I've, worked hard and maybe our properties are skating through this challenge, but they're still not making money. I mean, I'm even for properties where I'm quite profitable, just out of an abundance of caution, I've told them, I'm sorry, I'm not distributing any cash. I need to just build my operating reserves. It's your money, it's not mine. If I don't use it, it's yours. I'll distribute it to you, right? So it's not like I'm going to sit and eat this money. It's just going to go into a bank account. It's going to sit there for a while. Sorry, but that's what I have to do because my job is to manage your money. And right now I see potential risk. And if that risk goes away, you'll get your money. So so there's people even in my database that are not particularly not happy with Neal Bawa because they're like, I have this property, it's doing well. By now, you kind of delayed cash flow during COVID, and then the cash flow came back, and now you're taking it away from me again. So not quite happy. I think they understand, but they're grumpy about it. And I think so. Raising money next year is not going to be easier simply because other syndicators have burned investors. I think there's a process where the mindset resets. 2024 will just muddle through. 2025, I think, is going to be a fine year and we'll do well. You said Alan Greenspan was really the first guy that advocated for lower interest rates. I believe all Fed chairmen in the future will advocate for lower interest rates simply because it's okay for the US to have these high interest rates for 1 year, maybe even a year and a half. It's no big deal. We're a very strong economy. But imagine if interest rates were this high for the next 10 years. Do you know what that does to the interest payment on the federal debt? I mean, you have to
yeah,
cut every program. You have to cut military, you have to cut Social Security, you have to cut, job entitlement programs or unemployment. Everything's got to be cut because you're basically spending $300 billion extra that you weren't spending before. So the political pressure from both Republicans and Democrats to keep interest rates low in the long run is extraordinary. In the short run, everyone's understanding of what the Fed's doing. They understand that inflation can prevent them from being elected at the next election. So they're like, yeah, go ahead, Fed, do your job. But once inflation comes down to a reasonable level, there's going to be a lot of pressure.
yeah. No, definitely, it's a interesting dynamic with the Fed, and you know, um, kind of some scary times ahead of us. But I think that uh, the wise syndicators and investors that understand the situation, the preventing a loss is really kind of prevent defense or whatever. Trying to prevent losing is really kind of the game right now. And
Yeah, and it's not that hard, right? So if I wanted to sum this whole thing out, I don't want to use the word scary because I don't think it's scary. I think it's just neglect. People are just not thinking about this because they're like, it'll get better. No, take a spreadsheet, plan out the next 18 months, and be reasonable when you think how interest rates are going to fall and how it's going to reasonably affect your property. Figure out how many dollars you need and put together a plan. It's not as many dollars as you think. You just need to look at it now. It's going to be lot harder a year from now, so you might as well look at it now. So I think this is really all about action, Darren, not panic.
Yeah, that's good. Hey, Neal, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and as such, I work with my clients to assess risk and try and determine what to do with the risk. And the three strategies we typically consider are: we first look to see if we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And when we cannot avoid nor minimize the risk, we look to transfer the risk. And that's what an insurance policy is. And as such, I like to ask my guest if they can look at their own situation. It could be political, interest rates, the Fed, clients, investors, tenants, however you want to frame the question for the answer for you. But I'd like to ask you, Neal Bawa,
Mhm.
what is the biggest risk?
Um, the biggest risk is to keep doing what you were doing before. Right now, we are at a point where we need to pivot. So, you named three things, and so I'll go through those three and tie them back to the biggest risk, this change. Right now may not be a good time to buy multifamily. In fact, I don't want to buy multifamily until about July this year, when something known as the spread, which is a portion above SOFR, is likely to drop. It might even just collapse. So I basically want to wait until that time. In terms of transferring risk, yeah, I want to go out and have my distressed fund not buy properties, but invest money into properties. Because when I invest money into properties that are distressed right now, have negative cash flow, I'm doing what Darren mentioned. I'm transferring the risk from my investors to the existing investors of that property. So if they change their PPM and allow me to come in as preferential money, I'm coming in ahead of them, and I'm transferring the risk of ownership of the property while I'm getting ownership of it to someone else. It's somebody else's risk. It's the GP and the LP's risk, not my LP's, their LP's. So if I can transfer risk successfully, I'm looking to do it by recapitalizing existing properties that I like. Nothing wrong with the property, just the interest rates are killing it. One day the interest rates will go away and the property will do well again. I want to own this property, but I don't want to buy it from the market because I think that the price is too high. So I want to recapitalize somebody else's property and put my investors in pole position and transfer the risk.
Hmm. That's an interesting strategy there. Are you finding lots of opportunities that way?
One a day.
Really? That's that's
Remember,
awesome.
the distress is there.
Right.
Everyone's ashamed to talk about it.
Right. No, that's good stuff. And you're able to with your investors come in and establish a position and put some capital in and
Looking to do so. As I said in my commentary, that the peak of the distress starts in Q3 this year. So right now is time for conversations, understanding those properties, seeing what they're doing. We're encouraging them to do cash calls first before they recapitalize. Cash calls, if they can get by with cash calls, good for them. I mean, that's the easiest way. That's what they should be doing. So we're providing education at this point of time, but there may be properties where the cash calls are not successful and they come back to us, they've checked off that box, and then their investors are ready for a you know change in their position in the equity stack after an unsuccessful cash call. So it's a process. I haven't done any yet. I've got 2 dozen properties that I've looked at. I think I like four, and I'm monitoring those four to see what happens in the coming months. And I'm also having conversations with my investors. I shouldn't be recapping any property at this point, but 6 months from now is different.
well, an interesting conversation for later to hear how you're doing that. So that's good.
Sure. There's more opportunity at a time of distress, not less.
Yeah, no, absolutely. It's the old Warren Buffett there. You get a chance to see who's swimming with shorts on kind of thing. So I like it. Hey, Neal, where can listeners go if they'd like to learn more or connect with you?
Two different ways. One, I'm the only Neal Bawa on the World Wide Web, so you can just type in Neal space Bawa and hit enter on Google, and you'll find my content and connections to me. The other one, which is more formal, we have about 75,000 people that are current subscribers of Multifamily University. The web URL is multifamily followed by U, the letter U. So multifamilyu.com. We do webinars each month on these kinds of thorny topics that no one else wants to touch. We do about 20 of them a year. We just did one. We had 2,600 people register, about 1,200 watched it live. So those kinds of events, I don't have a podcast, so you can't listen to one, but I have been on over 200 podcasts. So you can go to podchaser.com and search for my name, and you'll find a couple hundred of them.
Awesome. Well, Neal Bawa, I cannot say thanks enough for taking the time to talk. I always enjoy it, learn a lot, and look forward to doing it again soon.
Awesome. Thanks for having me back, Darren.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CRE PN Radio.